Most options traders at SMB Capital's options trading desk go through various stages of learning how to trade options. They first learn the basics of options, then they learn simple strategies with strict rules. Then they move into strategies with fewer rules and more guidelines and general concepts. And then finally, they become skilled in learning how to determine which strategy will play best in which market and then implementing that strategy. That fourth stage, that learning how to initiate and maintain strategies at the right time in the market, is what the Rock Options Strategy Series is all about. It's about initiating a trade in a way that maximizes the chances for a profit, and then morphing and changing that trade over time in sophisticated ways as the market changes. It's a very powerful strategy with a tremendous profit potential if traded and learned intelligently. This month we are providing a special on the Rock Options Strategy Series, and if you go to smbu.com/rock, you'll see the special pricing and the special packages that we have created for this powerful options trading strategy. Thank you. Hi, I'm Seth Freuberg. I'm the Director of Options Training here at SMBU in Manhattan. I'm also the head trader of SMB Capital's options trading desk. So I'd like to talk a little further this week about backtesting. It's an important topic, and I think that people need to get a correct perspective on backtesting in order to have it become a useful part of their trading discipline. So why do you backtest at all? The major reason to backtest is to see if statistically over time a strategic concept that you've developed actually works. So when you go into a backtesting process, the first step is oftentimes a trial and error process where you realize that one of the trade rules you originally set up isn't working right. And so you make a change, you go back to the beginning, you trade it again, until you come up with a set of rules that look like they probably will work over time. They probably make sense over time. Then you, through backtesting it, you're building what I like to call muscle memory. You're building up a reflexive approach to the trade so you know exactly what you need to do, when you need to do it. So if the market's moving quickly, you won't panic and freeze. You'll know what to do. Another very, very important part of backtesting is the fact that it helps you to build your confidence in the strategy. So that if in your backtesting you saw there was a 5-month period in a row where the trade lost, but ultimately had an expectancy of 3 or 4% a month, which is spectacular, then you would stick with the strategy. When going through a live trading period, you lost 5 months in a row. Rather than bailing out at probably the worst time, you'd stick with the strategy, and it most likely would work over the long term. So it becomes a trial and error process, it becomes a muscle memory builder, and it becomes a confidence builder. So for all those reasons, it's an excellent practice, and in fact, every solid options trader that I know is a fanatical backtester. So it does work. So it's important to consider this. Let's now move from back trading into live trading, and let's think about the market a little bit. One of the very, very first lessons I learned 10 years ago when I first started trading options was from one of my early wonderful mentors, and he said, the market can do whatever the hell it wants to do whenever the hell it wants to. And I will say after 10 years of options trading, that is truer today in my mind than it was 10 years ago when I first heard it, because I've seen lots of different kinds of markets now, and I see how true that is. And so with that, you can take that even further and say the market can react to anything any way it wants to react to it. We've all seen jobs reports where the market, you get a spectacularly strong jobs report and the market sells off. Now, what's the explanation for that? Most likely a fear that that jobs report is going to cause interest rate increases in the Fed's decision-making process. I've also seen jobs reports where the market rallies based on a strong report because there was a fear that the economy was weakening prior to the report being released. I've also seen jobs reports which are terrific and the market did nothing. It just sat there, literally did not react to it. So, therefore, I think I just proved to you that the market could do whatever the hell it wants to do whenever the hell it wants to. So, realizing that then, if you are trading something you backtested live and determined statistically was going to work out in the long run, then why would you change the strategy because of an upcoming event? And you probably recognize this concept because you've probably done it yourself. You will skip trading because something big is coming up. You'll cut your trade short because something big is coming up. And so you might, in a year, if you get carried away with this, over considering the news in your decision-making process, then you may only trade 8 of 12 months in a particular year because there's usually something big about to come up. And so if you get scared off of staying in the strategy as a result of whatever would come up in the news, then basically you will not be trading like you're backtesting. When you backtest, if you're not looking at the news in your backtest, then you most of the time should not be looking at the news when you're live trading it, because you establish statistically through the backtest that the trade works over time. So you are interrupting the statistics of the trade by picking and choosing which months you'll trade it, picking and choosing which months you bail out early, picking and choosing the months where you trade it differently than your backtest. And my experience has been, if you do this, you will come to regret it, that most of the time, if you had just stuck with your strategy and didn't pretend that you knew how the market was going to react to a particular event, you're going to be much better off from a trading perspective. So let me just drive this home in a very simplistic example for you. Suppose hypothetically the year 2016 will play out this way. Suppose if you traded by the book, you got a 30% return, and you can see on the screen different returns in different months, some positive, some negative. You'll notice July in this hypothetical is a 9% winner. There were a bunch of losers in there also. July we're going to call a 9% winner. Now, suppose that you became overly concerned about the Brexit announcement. And as a result of that, you cut your loss, you cut your trade short in July. Brexit was June 24th, so you probably would have been in the middle of, let's say, your July trades at that point, whenever that was in June, late June. And so let's say you decided, you know what, rather than risk Brexit, I'll just close my trade now with a 2% loss. Well, it would have been a 9% gain had you traded by the book. That 11-point swing turns your 30% strategy into a 19% strategy in the hypothetical year 2016. It might have sounded really reasonable when you were closing that trade with the 2% loss, earlier in the week during Brexit. Might have sounded brilliant and really reasonable, and it actually would have been a terrible mistake in terms of your annual return. So, what is the moral of the story? There's no real point to backtesting if you're going to trade differently than your backtest. If you didn't backtest it with a news element, then you can't trade it with a news element as a part of your decision-making process. It's not wrong to use news when you're trading. In fact, intraday equity traders use news to their advantage all day. But if you have a strategy whose confidence was built up in your mind by your backtests, then you've got to trade it statistically, not based on the news. Furthermore, you don't really know how the market is going to react to that news. All the talking heads on the TV and all the websites you read can have all sorts of views and opinions, but at the end of the day, they could all be wrong, and frequently the majority of them are wrong about how the market is going to react to a particular event. So therefore, if you're going to go through a statistical process, which is what backtesting is, but you're not going to trade it and allow the statistics to come to fruition, then you probably shouldn't bother backtesting at all. And it may be very valid to not trade through backtesting. It may be very valid to trade through use of the Greeks or some other concept in options trading that you feel you can competently handle. But if you're backtesting to legitimize a strategy, you should backtest it, you should trade it the vast majority of the time the way you backtested it. And that's what most very successful options traders do. They don't pay a tremendous amount of attention to the news. What they do pay attention to is the perfection of their strategies or the optimization of their strategies. So trade it like your backtest. Otherwise, you're liable to actually create a worse outcome for yourself by not trading it like the backtest did, and then you will come to regret those news-based decisions as an options trader. So I hope this provokes some thoughts in you. Think about why you're backtesting, think about why you're spending all that time, and then use that time, leverage that time intelligently, and that will be most likely the best way to create a great outcome for yourself. So thanks very much, and we'll see you next week.